Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Do you feel the Bank of Canada is going to hike interest rates this week? And if they do, what will that do to the housing market?
Are they going to increase interest rates this week? It looks like I'll let the economists play with that one, Jim. It really is not going to have any bearing on the housing market. The reason I say that is that we had a 2% interest rate rise effectively take place in the housing market. And what I mean by that is that when the OSFI changed to the mortgage qualification rate last fall, November, they instituted a 2% interest rate increase in what you had to qualify at. So in other words, instead of qualifying at 2.09%, which is what a 5-year mortgage rate was in November of last fall, the OSFI said you have to qualify at 4.64%. Now, what happens when that magnitude of a change takes place? That is the consequence on the housing market is exactly the same as if interest rates had increased 2%. Because the government will not allow first-time homebuyers with less than 20% down to purchase a home based on their income level at today's 5-year interest rate at a mortgage that they could get. What that automatically meant is that once that came into effect in the marketplace, in other words, when first-time buyers began to gain a larger share of the sales that were taking place. So in other words, if they were 10 for every 100 sales were first-time buyers, now we're going to increase to 15 or 20 first-time buyers out of 100. Normally when that happens, the average selling price decreases, obviously, because you have a bunch of lower-priced homes selling in the sales mix. But what a 2% interest rate qualification rate, which is the same as interest rate rise, does, is it effectively cuts off the buying power of the first-time home buyer. With this particular change the OSFI made. What that meant was, in a lot of places in Canada, about 24% of your buying power was lost. So had you bought a property in November, before the price came into effect, you would qualify to have bought had a 24% bigger mortgage than by the time it had fully rolled out this spring when the first-time buyers were buying and they had lost that 24% advantage. When you look at the sales mix across Canada in every region, you'll notice an increase in sales of properties that were priced in the lower categories. So this was not only because first-time buyers had increased, but it was also because they were only qualified to get a smaller mortgage. So the normal little decrease we saw became a much larger decrease. That's how you had your price drop happen in the GTA between April and July and August. The impact of this rule change, which is the same as raising interest rates 2%. The impact in the market is exactly the same. So this little tiny 0.25% interest rate change we're talking about now, that would maybe move the qualifying rate for first-time buyers to 4.84%, which is what it is today, to 5.04%. I don't think it would go to the 5.09. It would probably stay at the 5.04, which would mean people have to qualify as if the interest rates were at 5%. Now, what your listeners need to understand, especially millennials or first-time home buyers, what the government did was, for the first time in the last 40 years, they told millennials, not only some millennials, but they told the millennials that were the most creditworthy, were the most responsible, had the best jobs, that those particular people no longer could qualify for the same type of mortgage that their parents and everyone before November of 2016 was allowed to qualify for. The very best home buyers, CMHC will allow you to spend 39% of your before-tax income on owning your home. 39%. Now, I know a lot of your listeners are going to say, well, that's crazy going 39%. Well, I'll tell you this. I sold literally thousands of homes where people were qualified at, were spending 39% of their income to own their home. So, and they never ever lost a home. No one ever lost a home that I'd sold a home to. So, even though that may sound extreme, practically speaking, Canadians have always followed course and haven't lost properties because of it. With this change, they effectively dropped that 39% GDS down to 29%. So what the government has done behind the backs of all the millennials is they are saying that you are not trustworthy enough for us to lend you the same, exactly the same 39% of your income in terms of payments that we let everybody else over the last 40 years participate in. Only now, at this moment in time, are we going to take that away from you. Now, I say take it away. I'm going to explain why it's taking it away. We have members who purchased homes in November of last fall, specifically in certain parts of Canada, I'm not going to tell you where, specifically for the reason that they could get a 2.09% 5-year interest rate and qualify at 38 to 39% of their income. Now, the reason why they did that was they were, in effect, saving 21% of their before-tax income was being banked in their house. Because the interest component of the monthly payment on their home was so small, so minuscule, it meant that their principal payment was huge. And that principal payment was just like saving money in the bank. So even if the house that they bought didn't increase in value at all over 5 years, their net wealth was being built so rapidly because they were saving 20% of their before-tax income. Now, I'll tell you, Jim, this is what the government of Canada, this liberal government of Canada, has done to millennials. They have taken that opportunity, it was fine for 40 years, Jim, for everybody to pay a whole bunch of interest every single month and a lesser amount of principal. But the moment that it reached its apex, where you were going to start saving the most amount of money in history as a millennial home buyer, the government said no. Now we're going to put a mortgage qualification rate in that effectively cuts that savings rate in half. What the government has done when we're talking about interest rates with this mortgage qualification rate for first-time buyers, millennials, is this. You are not going to be allowed to build equity as quickly as possible as your parents, your uncles, your grandparents, everybody that bought a house up until November of 2016. Now, you're going to have to enact a totally different strategy, because not only are you going to be forced to buy a lower-priced home because they're not going to lend you the money anymore, even though now you're only spending 28% of your income on your house, that means you're going to have to sell at least one more time during your lifetime. One more expensive trade you're going to have to make. So not only did they take away your opportunity to save 20% of your before-tax income simply by buying a house, they're also going to add in effectively about $120,000 of costs because of an extra trade over the course of the lifetime of your home. That's the net equity that you will have lost. It was this little tiny 0.25% interest rate that everybody's getting their shorts in a knot over right now, Jim. It doesn't matter. You are already up 2.25% in terms of qualification. You can now only buy a house pretending magically that interest rates are at 4.84%. So now you have to employ a different strategy to be able to save that exact same 20% of your before-tax income with the home you buy. Now you have to cut your amortization down to 17 years. Because right now, if the interest rates rise this week or not, before this next interest rate rise, the only way you can save the exact same amount of your after-tax income or before-tax income that a millennial was saving in November of 2016 is to reduce your amortization to 17 years. And we are the only place in Canada where you would hear that. And everybody questions, well, is the membership worth it? Is it worth that $19 a month? I just say, people, anybody here, we do a home ownership savings rate for every single one of our members. The home ownership savings rate tells you how much of your before-tax income you're saving in your house.
We'll have more with Ross Kay right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're chatting with Ross Kay. Ross, just before the break, we're talking about how the Trudeau government has made it so much harder for millennials to buy a home, or anyone in any age group, really. Why did they make the qualifications so much stiffer?
Why did they make great, absolutely fantastic question, Jim. Incompetence or ignorance are the only two answers. First of all, homeownership savings rate. Google it. Everybody who's listening should Google homeownership savings rate. You're not going to find it anywhere. Okay? That's because they don't understand how homeownership works, how homeownership math works. What they worry about is these fictitious claims about rising interest rates. And I don't know why everybody believes this. Honestly, Jim, I really don't know why people with PhDs actually believe this. When you look at an amortization table for a homeowner, and you look at how quickly they are paying down mortgage debt. So if you purchased a home with 2.09% interest for 5 years on a mortgage, you are going to pay off 15% of that mortgage in the first 5 years that you own it. Now, in 1990, when your parents were buying a house, they would have paid off about 2%. What you have to understand is that your monthly payment is made up of two parts. It's besides the property taxes and utilities or whatever else. It's made up of principal and interest. Principal and interest, we call them the twin sisters of home ownership, equity, and debt. We call them that for a reason, because the way that they interact with one another dictates how quickly you build wealth in your house. They have always interacted this way. People have no idea how much of you had to spend back in the 1990s to save a buck pay off a buck of your principal. You're looking at we have an index where we measure both, Jim. And when we're looking at those numbers, let me give you an example. So at this time, in August of 1990, you were looking at about a 12% interest rate for a mortgage. And what that meant is that for every $100 in monthly mortgage payment you were making, only $7.35 was going into your own bank account. That was what was being paid off the principal in your house. Remember, your house, the principal that you have in your house, called the home equity, is how big your bank account is in your house. At the very peak of November of 2016, we were able to get 1.99% interest rates for our members on 5-year mortgages. So for the very few people who jumped in at that lowest of lowest rates, 64 out of every $100 was going into their paying off principal. Okay? So they went from $7 per hundred to $64 per hundred. We don't care whether it's interest or principal in terms of qualification. The government didn't care until November of 2016. The government always cared is, we will let you spend 39% maximum. For the best credit people, the highest credit scores, the best loan repayment history, the best jobs, we will let you we will let you make payments of 39% of your before tax income. They changed that. And they changed it radically. So this made a huge change with how you had to structure your home ownership situation. I just explained to you, your parents, millennials that are listening, when your parents purchased, if they purchased in 1990 and they had a 12% mortgage, only $7 out of every 100 that they spent went into their own pocket, meaning paid off the principal in their house. The other $93 went to the bank to pay the interest. In November, there are people who put 64 out of every $100 in the pocket, and they only gave the bank 36. You don't see these numbers appear in the Government of Canada's discussions on this. You don't hear realtors talking about this. You don't hear financial advisors talking about this, because everybody has their own little area where they want to be focused on. Our area of focus is building that wealth in your home. And we know that in November of 2016 was the greatest net building wealth opportunity in the history of Canada. Because you try to go out there and you find me one person that you know of who was able to save 20% of their before tax income every single month, guaranteed for 5 years. What I can tell you with dealing with thousands of families, I do not know of a single family who could rent a house, do whatever they're going to do, and still take 20% of their before-tax income and save it. If you can find me one of those people, they're the outlier that I haven't met yet.
We'll have more with Ross Kay right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ross Kay. Ross, the real estate people tell us year to year, home sales in Vancouver are up 20% August to August. In fact, a little over 20%. Meanwhile, in Victoria, they're telling us home sales are down. Well, are they what? Up or down here in BC?
They're both. But I'll also tell you that the markets are going exactly how we have forecasted they would go. And we would also tell you that we don't use year-over-year comparison. And we would also say that mainstream media who is reporting on this, because I know what you're talking about. I watched it happen on TV today about the Vancouver issue. They're just out to lunch. I mean, it's bizarre. So let me explain it to you this way, Jim. Victoria's trading cycle was behind Vancouver's because Victoria is a peripheral market of Vancouver. The same way that in Ontario, St. Catharines or Hamilton is a peripheral market of Toronto's. So Toronto's market turned prior to those markets turning, which is exactly what happened in Vancouver, which is exactly what we warned everybody about, which is exactly what all of our members' dashboards showed them. They would ask us, well, why are you saying you're forecasting these lower prices when this other market is saying this, or the real estate board is saying that? And we would say, because we know when your market rolls over, we know how the prices trend, we know what impacts are going to hit it. Mind you, we also have to calculate for that mortgage qualification rate change that we told you about, because we know how that's going to impact the market. So what's really happened in Vancouver is this. This is really how simple it is, Jim. There were 1,168 people who sold their house in May, June, and July in Vancouver who finally found their next home in August. That's all that happened, folks. There were sales missing from May, June, and July where there wasn't a companion sale reported on the real estate board. So when there's not a companion sale, what that means is somebody sold their house and they didn't buy another one. Well, traditionally, there is anywhere between a 60 and 120-day window, depending on the marketplace, depending on the time of the year, depending on what location that you're buying in, depending on the kind of home that you're buying. There is that window where you're technically homeless. You've sold your existing home, but you haven't bought your next home. You haven't found it yet because you couldn't buy it without having your existing home sold. In 2016, prior to the market turning in Vancouver back in March of 2016, again, months before the foreign buyer tax was even announced, what people were doing is they were buying their second house and then putting their current house in the market and selling it because they were told the market was so hot that they would have no problem selling. That's what they were told. So when we look at March of last year, when we're measuring why was the market so hot back then, you were down to 28 days. So the average homeowner, was selling their existing home and buying their next home within 28 days. That was below even 30 days. It wasn't even a month separate. So that meant that there was a whole bunch of people that were buying first, selling second. That's what we call a market is oversold. Anybody who would have listened to your show back then would have heard me talk about being oversold. When a market comes out of oversold condition, now, and this is repeated over and over again, even on your show here, Jim. Calgary was in this situation back in 2014 when it rolled over. Vancouver's in this situation in 2016 when it rolled over. Toronto was in this situation in March of this year when it rolled over. Because real estate agents get greedy. They get cocky. They start saying things that for a decade or 15 years they would never consider saying because they know what it's like when someone gets caught owning two homes. But when a market reaches that peak and everybody starts to believe that it's going to go on forever, they tell people buy second, buy first, sell your own second. Because maybe your own will go up in price while you're waiting for while we're searching for the house that you're going to buy. Or you're not sure you're going to know what you're going to be able to buy if you sell. So why don't we buy first? No, that way you know you've got something and we can sell your own. That's how the role of the market goes. What you're seeing in Vancouver was this month for August, the reason you had that 20% supposedly year-over-year gain was simply because there were 1,168 sales reported in, people who sold their homes in May, June, and July who ended up buying their next house in August. In Victoria, it's just the opposite. They're on their part of the market where Vancouver was in March of last year. That's exactly what's going on.
Ross, thank you so much for chatting with us.
Thanks a lot, Jim.
My guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.